So many people have asked me, how do you price an IPO? How does a company that is issuing an IPO to its shareholders for the very first time determine what is the final price that has to be allotted at the time of giving the shares to the shareholders? Hello, everybody, and welcome to this video on pricing an IPO. This is not a valuation video, it's a video on understanding the book building process. I'm your learning friend, Sushila Hariharan, who has over 15 years of capital markets experience, having trained more than 20,000 executives in different global investment banks across multiple locations. If you're interested in a career in fund accounting, corporate actions, trade life cycle, and OTC derivatives, do subscribe to my YouTube channel where we provide research content and focused on these subjects. An IPO is an initial public offering, which is perhaps the most important event in the life of a company because a private limited company which has its shares held amongst a few shareholders, including the promoters, the institutional investors, etc., is now transforming itself into a public limited company where its shares are listed on a stock exchange. The shareholding is distributed amongst a large number of investors, and the shareholders now want to participate in the shares of the company. This transformation is an extremely important event in the life of a company and perhaps the most important event in the life of a listed company. That is a transformation from a private unlisted company to a public listed company. We have so many stories, those of Google, Apple, Microsoft, Meta, etc., which were all well run private unlisted stocks, and they transformed themselves through an IPO at various points of time, including Meta, which originally was called Facebook, which did an IPO at perhaps the worst possible time. There's the 2008 financial crisis, and it has transformed itself into a public listed company. Through this listing, the shareholders also get to participate in the profits and growth of the company. An IPO size. Okay, how does the company and the investment banker working with the company determine what should be the size of the IPO? So they first make up their plans, they decide how they're going to use the money, what is the appetite of the investor for the shares of the company, and in simple accounting language, the IPO size is nothing but the number of shares multiplied by the price per share. I'll be doing another video on pricing per share, which is a concept on valuation of the company's stock at the time of the IPO. Over here, let's just take it to be a very simplistic accounting entry, which is nothing more than number of shares into price per share. The IPO size is therefore a right number to get at. If the price is too high, the investors may not subscribe to the shares. The IPO will become a failure. If the price is too low, the investors want to apply more and more. And then the promoters are thinking, oh no, did I make a mistake by giving away my shares too cheaply? Okay, so getting the price right is the most important aspect of determining the IPO price, because investors are also very cunning guys. They're neither bullish nor bearish at the time of an IPO. Okay, why do I say that? Because they don't have a trading position yet. But if the price is right, the stock becomes attractive to them. If the price is not right, the IPO becomes unattractive to them. Okay, so this overvaluation, undervaluation is a continuous phenomenon, and it's a world of uncertainty because the last few records of the company are audited, but they are not disclosed to the public, right? So the pricing of the IPO is the first time when the company also announces its financials on a public platform. So the price has to always be right. Okay, now this is a very vague zone over here. This vague zone of having to determine what is the right price depends on multiple internal factors of the company, but it also depends upon external market conditions. So, in an attempt to navigate what should be the right price, companies normally apply for a book building process. The book building process is where the number of shares is offered is predetermined. Okay? The number of shares that is offered to the investors is predetermined. The shares are offered for sale at a price band. This price band is an attempt to understand and gauge whether the investor is interested at a specific price or not. This price band is the band within which investors bid for the shares. Okay? It can be they can bid for the shares at or above the lower band, at or below the higher band. Okay? So it's within the band, investors have to bid for these shares. The book building process, let's say, for example, the price band, after doing a comprehensive valuation exercise, the investment banker has decided that the price per share of a company can be anywhere between $4 and $5. All right. So, this is the band at which investors can apply. Okay, it's not mandatory they should apply only at $4. This is not mandatory that they should apply only at $5. They can apply at any price within this band. The band helps investors also know what is the capital allocation that is needed for this specific stock. And therefore, the price band is an extremely important element of the whole book building process. The investors can apply for the shares at or above the lower band. That means they should be above at $4 or more than $4. All right. If the it can be at or below $5. Yeah, I'm very bullish on the stock. Okay, let me apply at $5.25. Not possible. That's not even a valid band. Okay, that's not even a valid price because it doesn't fall within the band. Or there must be somebody else who's like, oh God, I'm so bearish on the stock, but I still want the stock. Hey, you're a bear, then why do you want to apply for the stock? But they say, no, no, no. If it's available at $3.50, apply for the shares. So they put in an application at $3.50. Any price outside this range is not considered. So even if the investor is very, very bullish and says, oh, the promoter doesn't know, but let me apply at $5.50, okay, that band is not going to be valid. It has to be within this range only, all right? So investors don't get to choose the band. They can only choose the price within the band, okay? This activity of big book building is therefore called as a price discovery mechanism. Okay, we are discovering the price at which investors will be interested to buy the stock. In secondary market trading, that's easy because you can see the orders in the system. You can see at what prices the orders are being filled in. You can see the quantity of the orders. You can see the prices. You can see the speed at which the orders are getting executed, right? But in IPO, you can't see all that. So therefore, we have to discover the price. We have to be able to gauge what is the price of the IPO. What is the price at which the investor is interested? All right. Let's say the IPO of a company is a million shares and the price band is $4 to $5. Okay. I'm really simplifying things over here, but you can extrapolate it to larger numbers and it will be still the same. Okay. Over here, I've used a very simplistic Excel sheet, obviously to make us understand the concept of a book building activity. But in real life, it's much more complicated. The principles remain the same. It's just the number of data cells that are there in Excel that will be used for an IPO will be much larger. Let me see if I can get an extract of any of the data cells that have been used for book building for an IPO. My favorite hedge fund is back. Hari Hedge Fund decides to apply for 200,000 shares at a price of $5. Is this a valid price? Sure, it's a valid price because it's within the band. So Hari Hedge Fund has evinced interest or has applied for 200,000 shares. Does that mean the IPO can close? No, we cannot close the IPO because we still have 800,000 shares that have yet to be sold to the investor. Okay, so let's understand this. Hari Hedge Fund has applied for 200,000 shares. The IPO size is a million shares. So 1 million minus 200,000, that gives us 800,000 shares that is still left to be subscribed to. So the IPO remains open, waiting for the next investor. And now let's see who's the next investor. The data parameters remain the same, and it's KH Hedge Fund. Okay, another favorite of mine, which applies for 500,000 shares. Okay, KH Hedge Fund has applied for 500,000 shares at $4.50. Is this a valid price? Yes, it's a valid price because it's within the price band of $4 to $5. But now, how many shares have been totally sold by the company? 200,000 of Hari Hedge Fund, 500,000 of KH Hedge Fund. That's 700,000 shares have been sold. But is the IPO still yet to be completely subscribed? Of course. There is still another 300,000 shares because the total IPO is a million shares. Both these investors, Hari Hedge Fund and KH Hedge Fund, have collectively subscribed to 700,000 shares. There is still 300,000 shares left unsold. In my utopian world, we have a third partner, SH Partners, SH Investors, who comes in and makes in an application for the perfect number of 300,000 shares. Okay? At $4.40. So you have three offers right now. The first one is Hari Hedge Fund, which has taken up 200,000 shares at $5. There is KH Partners that has taken up 500,000 at $4.50. And the third investor comes in at 300,000 shares at $4.40. At this point of time, all the shares at the IPO are fully subscribed for. The exact subscription. This is like a dream world. Okay. In real world, you'll have oversubscription, undersubscription, etc. That's another video, another time. But this is just a dream world of exactly 200,000 plus 500,000 plus 300,000. That gives us a million shares that have been sold. Yay! The company is very happy because it's been able to sell its 1 million shares. But now the price that each of these investors have subscribed to are different. Now, how do we sort out this matter? Let's say this. Hari Hedge Fund, let's just tabulate all this into a simplistic accounting Excel sheet. Hari Hedge Fund has subscribed to 200,000 shares at $5. KH Fund has subscribed to $500,000 at $4.5. SH Partners has subscribed to 300,000 shares at $4.4, totally making it a million shares to be sold. So you can understand from this table over here, each investor has put in applications of different trade quantity or of different quantities as well as at different prices. Let's go through this each one by one. The first one, when Hari Hedge Fund has subscribed to 200,000 shares at $5, was the issue fully subscribed? The answer is no. The issue was not fully subscribed. Therefore, KH Fund was also permitted to participate on the IPO. At this point of time, they made an application of 500,000 shares at $4.50. Was the issue fully subscribed? No, the issue was not fully subscribed. And finally, SH Partners has subscribed to 300,000 shares at $4.40. Now is the issue fully subscribed? The answer is yes. So the IPO price now is $4.40. Okay? So when till the issue gets at least fully subscribed, the IPO remains open. Okay? Secondly, but that makes no sense because we have multiple prices for each of these investors. So what, each one a price for different prices? No, we have determined that the IPO price is $4.40. Hari Hedge Fund has applied at $5. So they will get a refund of 60 cents per share. Okay? It's not that Hari Hedge Fund pays $5. The IPO will be at a single price, that's $4.40. So Hari Hedge Fund, which has paid 60 cents extra, will get a refund. What about KH Fund? KH Fund will get a refund of 10 cents per share. Okay. And what about SH Partners? SH Partners, because they actually helped close the IPO, they will not get any refund because the IPO price over here is $4.40. Thank you so much for listening into this video. Keep learning, keep growing with me, Sushila Hariharan. Thank you.